computers. We're good to go.
Hello, everyone, and welcome to another CFA Corner with Tim Fitzwilliams and our portfolio investment manager, Mr. Ron Wright. How are you doing today, Ron?
Doing well, Tim. How are you today?
I'm doing good. It's funny that you're doing this over the internet today, because I know we recorded a whole thing for all of you. We recorded a whole thing, and the facts are some major things happened in the world that we felt like we needed to address that were not addressed. Because shortly right after our recording, the unfortunate start of the bombings with Israel and Gaza happened. So we wanted to take some time and go back and kind of just refresh everything. Plus, Fed results came out, so here we are.
Yes.
So we're going to do this through Zoom today. So apologize for the quality. We're working on getting better camera stuff, as we're going to start here soon. This on a regular basis, as well as a podcast and possibly a radio show with myself, Ron, Brian, and my lovely wife, Corinne. So this will be fun, getting back to how we used to do things. But with regards to the most recent events, especially that of the Israel-Gaza conflict, that's going to have some effects on the market. And how do you see those effects working in our current portfolio and working for or against us?
Right. Well, I think it's important. We kind of talked about this before we started the video, and we agree completely that this was a tragedy. It was
absolutely
a horrible thing. And what Hamas, a terrorist organization, did, attacking Israel that way, is just it's almost beyond belief. And Israel certainly has the ability and the right to strike back and to rescue their citizens. So,
right.
So it's a tragedy, and we don't want to say that it's anything less than that when we're looking at how it's going to impact the markets. But it's also important for us to know what are we going to do to respond to this, and how we're going to see things. One of the things that I think of when these kinds of conflicts happen, particularly in the Middle East, is this something we've seen in the past, that we can get some idea on how things might unfold. And this is somewhat different, but I think the closest proxy that we have to that was way back, it's way back in the 90s, 91, the Iraq invasion of Kuwait, and how that impacted global markets, and how that area, that region, became so destabilized, and the United States response, all these things that went in there. And
absolutely,
there was a study that looked at those things and how the markets responded. And the initial response in the first few months was negative, but by the end of a year or so, the markets had actually turned around and gotten positive. So these tend to be short-term events that have that cause a lot of volatility, but they don't tend to have long-lasting implications for the markets once we start to understand how things are unfolding. Does that make sense?
It does. So we're saying it's not going to be a permanent effect. It's going to be more of a spike, and kind of figure out things from there.
Right. Yeah, certainly. And we don't know what else is going to unfold. We don't know if Iran is going to get involved. We don't know if Hezbollah is going to get involved from the north. We know fairly certainly that this is going to impact oil supplies and oil distribution. So, we're certainly anticipating higher oil and gas prices as a result of this, at least in the short term. And we already have positions within our portfolio in energies. So we've actually seen some benefit from those higher prices in our portfolios, and that's helped to offset some of the volatility.
Right, because we had those positions due to the forecoming of some type of recession, which we'll talk about a little bit later. But we had those positions already. It just so happens when this unfortunate event happened, we are able to somewhat benefit in the fact that we were already positioned in where we think the prices are going to go up in oil.
Right. Yeah, exactly.
Well, that's good that we were kind of ahead of that. Well, obviously that's not planned, but it does make sense because we were being defensive thinking about the recession. And here's another exogenous event that can occur that can push us in towards the recession very easily,
Right.
depending on how it shakes out. That's the thing with these events like this. You don't really know how it's going to shake out, or what other players are going to get involved that can make it a lot more difficult, which
Right.
really kind of speaks to how should we be positioning ourselves in the market right now when you read headlines and you still see things that are going up. People are chasing dollars, and the Magnificent Seven, still very popular. A lot of people are really hyped on that, but at the same time, there's fundamentals and raw economics at work, which we see with the Fed and things like that. I know we'll get into that just a bit too, but just looking for right now at the positions that we have relative to what's going on in the market. Are we still hedged for a recession? And if so, how are we doing that? I know you stopped, quote unquote, shorting, buying, inversing for bonds and whatnot, but we have a guest today. We have a guest back there. We do. That's nice. That's Teddy, everyone. That's the newest addition to our family.
It's always fun. Dogs are always fun.
Yes.
So yeah, our positions right now, yes, we took the position, we sold the positions that were the inverse or the short positions, and those hedges, we lifted those off in about early June, I believe. Now we were very conservative in the first several months of the year, the first half of the year, really. And even though right now you might not understand if you just looked at things as they are, and you look at the growth in the Magnificent Seven stocks and these things, and say, why in the world were you conservative? But I want to remind you of a couple of things that happened during the first half of the year that nobody even thinks about anymore. We had Silicon Valley Bank go under. We had another bank in the United States in New York that had to be rescued. We had a major bank in Switzerland that had to be rescued. These were not small things, and there was a major banking crisis in the first quarter of the year.
All is high risk. All can create a lot of volatility.
Right.
Because when you just look at the market is being so heavily weighted by the Magnificent Seven. I think, what is it, 20% now? Is it more than that?
A little more, yeah.
A little more. That's crazy to think 7 stocks run the S&P 500 like that.
Right.
So when we're looking at things, the headlines, and everybody's like, oh, this is what's going on in the market and everything's doing great. But the reality is there's some real major things. And so if you look at it from a risk tolerance and a risk weighted return, I think that's how we like to focus the portfolio is, what is your risk tolerance? Are you a 60-40 person, an 80-20, a 40, whatever, right? 40-60, the opposite. Where should you be? And quite frankly, Ronald, no one really the Magnificent Seven, all in that level of risk. Not for our clients that are retirees that are trying to grow wealth or preserve wealth, make sure they don't run out of money, make sure that they can do the things that they want to do.
Right.
Risk is going to be more hedged on the conservative side for the majority of our clients. Yeah, there's some folks out there that like to be at high risk, and that's totally fine. But what I'm talking about is that when you have this environment of the economy and these exogenous events occur, the rest of the market is getting affected by it, but you don't see it as clearly as you would because of the overcapitalization of the Magnificent Seven. Is that right?
Yeah, that's fair. That hides the effect of those stocks, and what's gone on with all the AI hype and all that has overshadowed what's gone on with the rest of the market. And one of the things that I like to look at is there's the cap weighted S&P 500, which weights the biggest companies have the biggest impact. And that's where we get that 20% plus of the market. But if we do an equal weighted, just an arithmetic weight of the S&P 500, it's actually down for the year. So
so it's only those 7 that are keeping things up.
Yeah, and there are way more stocks hitting 52-week lows right now than 52-week highs. So it just kind of masks the reality of what's lying underneath. And there's a lot of headwinds that we have too. UAW strikes. We just got done with the Hollywood strikes. I don't know that I know that there was an impact there. It's kind of harder to quantify that, but the UAW is a pretty.
That's the automobile industry strike, right?
Yeah, exactly.
The unions there pushing for like a 40% increase or something like that.
Yeah,
pretty drastic.
pretty substantial.
Pretty drastic. Yeah. In economics, we say that that's normally a bad thing. That you think that it might be a good thing humanitarily, but in reality, it creates inefficiencies in other sectors. Long old story example was the idea that if you put tariffs on steel and you give lots of subsidies to the steel workers, well, what's made of steel? Cars. Who buys cars? Everyone. So therefore, even though you protected that one segment, you hurt everyone else.
Yeah, exactly.
And that stands true here again, right? We're not talking about steel, but we're talking about the auto industry themselves. So if they're able to find a way to give 40% to the workers, then we can expect in some way they're going to get back that 40% through the consumer, which is everyone else, you, me, and everyone else, right?
Right. Exactly. So that becomes
a drag, concern,
right? And that's the same thing with higher energy prices. All these things become a real drag on the growth of the economy, and so they're going to slow things and pull things back in. And we have other things that are coming along too. We have the student loan payments are starting again this month.
Sure,
so that's just going to start impacting people and causing them to have to rethink their budgets and what can we spend money on, what can't we spend money on.
So what I'm hearing is there's a lot of news, especially with the Israel-Gaza conflict and student loan starting. There's all these events. There's these things that just kind of, even from a common sense perspective, screams at the top of their lungs, volatility.
Yes.
And so I think we have to take a moment and go back to last year when you navigated us through volatility and allowed us not to lose like everyone else. I mean, most people lost like 20% in the S&P 500 or in their portfolio. Most people lost that amount, and we lost just about half that. So when we look at things, we have to count that in. So we may not be following the trends, if you will, right now, because we think that there's a lot of stuff going on that creates volatility, but we still have all those gains from last year. I call them gains because we didn't take losses. To me, that's a gain that we need to calculate back in and make sure we look at our risk tolerance and not just chase after the dollar, chase after the Magnificent Seven, or chase after AI platforms or things like that. Because when you do, that's when you get burnt. Now, it's okay to have a portion of your portfolio if your risk tolerance agrees to that, but you don't want to start thinking that you are that trend. Just because you read, oh, this market's up, the NASDAQ's up. Well, you're not a NASDAQ person, meaning you're not all in the NASDAQ. You can't, because the risk tolerance wouldn't allow us to do that from a fiduciary standpoint. Is that right?
Yeah, that's exactly right. The other thing I would also include with that is to remember that a typical market cycle is 3 to 5 years. And we've only been in this correction here for just a little under 2 years at this point. So we're really not even to the halfway point. And market cycles actually have been stretching lately. You know, in the last 50 years, they've stretched out longer. So it's more likely that we're talking about a 5 to 7 year market cycle, which is peak to trough and back up. And so it's to look at where we are right now and think this should be done, I think is a little disingenuous. And to look at performance for, you know, the year to date or even just 3 months, you know, people in the internet world that we have are getting very short-term focused, and we have to help stretch that out and think of things in longer term. So now we look at, okay, how did we do last year? And by not losing nearly as much in terms of the dollar value of your portfolio, now you've got a much higher base to build off of as we move forward into the next phase.
That's what matters, right? How much money do you have in the account?
Right. Exactly.
That's the main thing, right? A lot of people get excited over percentage gains, but in the reality is you can have a high percentage gain and still lose money. I know that's crazy, but sequence returns works like that. So it's one of those things that you just have to look at the dollar amounts you have in your account. Well, with that being said, I'm talking about the events, talk about the holdings we have. Everybody wants to know, are we done with inflation, right? The Fed has come out and said that they're not raising it this quarter. Great. You know, are we looking at another raise here soon? You had mentioned earlier in our talks that you thought that the market really isn't expecting a rate hike. What are your thoughts to that? We talked about inflation in the past CFA corner, that we're waiting for it to get under wraps. Do you feel like we've kind of got it under control now? Where do you think we are with that?
Yeah, so of course, the main focus of the Fed lately, since they started all these rate hikes, has been inflation. And we went from a time of them saying, oh, it's transitory, and it's just going to self-correct. And then to all of a sudden, wait, we got to do something. And so we had a 5.5% increase in interest rates in a year, which was the fastest ever in the history of our country. And that was to get inflation under control. And we've seen it really come back. The Fed's preferred measure of inflation is what's called the PCE indicator, the PCE deflator. PCE stands for personal consumption expenditures. And then what they look at on there is what's called the core PCE deflator. So that takes all of the things we buy, the prices for all the things we buy, and we strip away the effects of food and energy, because those are very volatile. And quite frankly, monetary policy cannot control food and energy prices. So we pull that out and look at that. And their target for the Fed is 2%. They want to see it growing at about 2%. The last report that we had on that came in, the overall core PCE came in at, let me check my notes here, 3.9% for the last 12 months, which is down. It's coming under control. But what we really want to look at is how's it currently doing. So what I normally will do is take a 3-month moving average and say, okay, for the last quarter by month, where is it running? And right now it's running at just about 2.2%, which is only 10% more than the Fed's target of 2%. So it's really come down, and even just slowing from where we were a year ago, a really big deceleration in inflation. So that leads me to say the Fed has been very successful in what they're doing. They've got inflation really coming down. So now is the time when they can slow down and wait and see about the ongoing effects of everything they've done, because there's a lot that's been done and we haven't really seen all that happen yet. And it's going to be compounded by things like the war in the Middle East, the student loan payments restarting, strikes by the UAW and others. These things are going to slow growth down even more. So the Fed is going to need to wait. And right now, the market is forecasting only about a 10% chance of another rate hike in November. I think that the likelihood is the Fed is done with hiking rates, and now we'll be able to focus on slowing things and just kind of looking at what do we have to do next, because we're really restricted right now.
Right, so very restricted, so hard to get money, right? Bills are going to be increased for people with college loans and things like that. Credit's restrictive, loans to buy properties, investment loans.
Commercial real estate is a big, commercial real estate loans are very, very difficult right now. And that's a very big problem right now.
Extremely difficult to acquire, and even to make monetary sense. It's just very difficult at this time. I totally agree. With that being said, we have inflation under control. How does that affect the recession? And you had mentioned earlier that we're only kind of in like the second year. We're looking maybe a 5 to 7 year cycle. When do we see ourselves actually embracing this recession? And what type of recession is it going to be? We've talked in the past about a growth-based recession as opposed to an employment recession. Can you shed some light a little bit about how you see the recession happening, when you see it happening, and what type of recession you see it being?
Right. Yeah. So a lot of the talk has been about whether or not we're going to have what they call a hard landing, which is a recession where you see unemployment spike up and people are losing jobs and it's a very difficult time. That's the traditional recession that we've had. So that's the hard landing scenario. The soft landing scenario is where the Fed somehow has managed to slow things down and bring inflation under control without pushing up the unemployment rate and causing all kinds of problems there. That's what we're hoping for. But that's more of the scenario of what we call a growth recession. So in other words, we may not see GDP, which is the gross domestic product, the output of the country, turn negative or contract, but it may be growing at 0.5%. 0.75%, where we want it to be growing between 2 and 3%. So slowing that growth almost to a stop where it feels like we're in a recession. And we're kind of balanced between those two. When we recorded earlier, I was leaning more towards the soft landing growth recession scenario. But there's some things that are happening, especially like this war breaking out in the Middle East, that's going to cause some other problems. So I would say that the hard landing scenario is still a possibility as well. And as far as
so, it could be rougher. It could be more volatility. It could be a deeper dive than because of these events that we didn't plan for.
Right. Yeah, exactly. And these exogenous events, that's what happens, and that's what ultimately drives the markets in different directions. But as far as timeframes, really difficult to forecast those sorts of things. If we end up, if we end up that in the fourth quarter of this year, we do fall into that growth recession, we won't even know that has happened until we're already into 2024. So it's always a backwards looking kind of thing. But I think that as we look at what market participants are doing and the way they're acting, it's becoming more and more brought forth into the consciousness of people that, something's changing, and we're not sure what. And what we're seeing as a result is really wild, volatile swings in different things. In particular, we've seen some amazing volatility in bonds. And when I say bonds, I mean treasury bonds, government bonds, particularly the longer.
They've been beat down because of the interest rates, right?
Yes. Yeah. So the Fed raising interest rates the fastest in our history, and now looks like they have stopped. And we had a 40-year bull market in bonds as rates came down from the 80s and the Paul Volcker era and fighting all that inflation. And now we've had a really rough time with those bonds. Last year, the treasuries lost 25%, which is unheard of. So we've seen some really big pullbacks there. Now we're looking at the other direction. And so that gives us some amazing opportunities, because we're into a situation where interest rates are at such levels and the prices on bonds have been pushed down to such levels that as we look forward to where things will be in 3-4 years from now, anticipating where interest rates are going to land and what the Fed is forecasting, there's opportunities for bonds, safe treasury bonds, not guaranteed, but safe, to provide returns that are in excess of stock market returns.
So you think there could be as much as double-digit returns as the interest rates come down in the bond market?
Yeah, absolutely. And there's a lot of mathematics that go into these things, but if we can see as much as a 3 percentage point change in those interest rates, those long-term U.S. treasuries could gain as much as 75%, which, even if we stretch that over 3 or 4 years, will exceed the average historical return in the stock market. So it gives us an amazing opportunity because of how far down things have been pushed.
That's very interesting. So bonds could be the new stock then, from a standpoint of expected growth here in the near future.
Yes. Yeah. And so it presents an opportunity that we can now look at bonds as a growth asset class rather than a safety asset class.
Okay, right. Which is nice to have both sides of the table. You can still be conservative traditionally, and at the same time still have a considerable amount of return in that. Now, can you do that just by going out and buying treasury bill, or is it more calculated than that?
Yeah, it's more calculated than that, because there's the whole spectrum of maturities that the treasury securities have, and you have to be able to see the right part of the yield curve, is what they call it, to be invested in, and take advantage of that. And treasuries are not as easy to get in at a good price point as one might think. It really requires much larger account sizes to do that. So the best thing that we like to use are treasury bond ETFs. And because they're commanding billions of dollars, and they can go in and buy and sell these securities and get really good execution, and gives us liquidity. We can get in
better price points, right? Because it's an industry level buy.
Absolutely.
Yeah. So that's the advantage that you have by being able to have those industry level pricing models that you can dive in and out of. And also, of course, the experience of knowing which ETFs are the ones to play in if you're trying to make the best run in the bond market.
Right. Yeah. And we're on the yield curve to place the.
So we're looking at that right now, then, for our
Yes.
clients. We're looking at right now shifting more into the bond portfolio for the purpose of getting better gains in a solid, well thought out model that's not chasing a dream or a desire like the Bitcoin or the AI type stuff.
Right. Yeah, exactly.
No, I like that an awful lot, Ron. I think that's very powerful. Well, we just wanted to address these things with you folks because we know that there's a lot going on. You probably have a lot of questions. So feel free to call us at any time. This is why we do this. We're going to be doing this a lot more. We're going to be starting up a podcast and starting up a radio show again with Ron, myself, Brian, and my wife, Corinne. So that'll be fun. So you can kind of hear everybody's different opinion on different topics as we go through things. So we really appreciate you taking the time out of your day to hear from us. And Ron, of course, we appreciate you a lot for being there and leading our portfolio and helping us through this time of uncertainty, if you will. Very much appreciated, and really excited to see what the future holds and what we have coming with this bond concept and some of the other positions that you have as we prepare for some type of recession.
Yeah, absolutely.
Excellent. Well, great. Well, thanks a lot for your time again, Ron. Thanks a lot, everybody at home. Take care, and we will talk to you soon. Goodbye.
Thanks.